Damian, what is the difference between, just for the audience, like 401k, IRA, and then EQRP?
So the IRAs are under one part of the tax code. It's kind of the default. Anybody that has a Social Security number can have an IRA, and then 401ks are a little bit different. They're under the Section 401, and basically those are meant for people that have some type of either side hustle or they have a business, and that can be as simple as a little consulting, or you could be a general partner and have some active income or active opportunity and be qualified. So both of those are great options for people as opposed to just being stuck in a mutual fund. And the difference is really with 401ks, including the self-directed, you can put about 10 times more money into that per year. And you're one of the biggest ones with real estate, especially, is that you're exempt from a thing called UBIT tax. And that's the biggest thing. If somebody has an apartment that they're investing an IRA in, it's really important to know about that and know that it's coming, that tax is coming, even if you're in a Roth IRA. And there's a way around that, and that is to convert it into a self-directed 401k or EQRP, the way that we set them up. And I think you asked the difference between self-directed 401ks and like solo 401ks and EQRPs. And there's a different way that we build it. We give you more control and more liability protection, and that those are the biggest differences. And it's under the same part of the tax code, but ultimately we're exempting you from UBIT tax, which is a potentially up to 40, almost 40% tax that is a surprise to most people, and we can get you out of it completely.
Well, let me tell you about this. So most people don't even know you can self-direct an IRA. Okay, and then of the small group of people that know how to do that, and they actually have done it, this is a shocker. And I remember doing this a long time ago when I quit my job, and I was like so hell bent on investing passively, right? And of course, one of the things you read about is investing with your IRA. So immediately opened up a self-directed IRA and invested in a bunch of stuff. Years later, Damian, years later, I get these notices about these taxes that are due in my IRA account. I'm like, what are you talking about? And it's this UBIT tax. Now, normally, if you buy normal stuff that doesn't have a loan on it, I don't know. I guess that would disqualify real estate. I guess if you're paying 100% cash is right, then you don't have this UBIT, this tax. But if there is something with a loan, maybe you can explain it here. But the point is this: I had to go file taxes out of my IRA going back like 7 years because of this thing. And it was such a mess. So what is this UBIT tax that you get in your IRA if you buy real estate or chunks of real estate?
I think you hit the nail on the head. With real estate, one of the best things is you can use debt. It's leverage. You don't have to write a check. Typically, if you buy a stock or you buy gold, you're going to write a check or you're going to pay for the whole thing. There is no borrowing. But with real estate, you get this leverage. And what the IRS did is they said, okay, well, you know what? We don't think it's fair that people are using tax advantaged accounts called IRAs to go and buy real estate and have a whole bunch of loans. So we're gonna equalize it, and we're gonna make them pay tax. So like if you had a 70% loan, which is common in a lot of multifamily, and even if you're a passive and you didn't take out the loan, but there is debt, you could be paying. I mean, you on $100,000 investment over a period of 5 years, you might pay 25 or $30,000 in tax, and it's because the IRS had this special rule. The funny part is when the legislation was done, the thing that was exempted was the 401k. And it was because a lot of major fund managers said, "Hey, we have developers using pension money and 401ks." And bottom line is, they just said, if you're going to use a solo 401k or an EQRP to go invest in a real estate deal that's got leverage, we're not going to charge you that tax. So, I mean, it's like your experience. A lot of people realized, wait, I didn't realize I'm going to get hit with this. The best part is, as long as your deal hasn't sold, you can move the asset from an IRA into a 401k, and now you're exempt. So you can do that 5 minutes before the property sold, but you
Oh,
can't
that's
do it after.
huge.
Yeah.
I don't think a lot of people know that. That's actually huge.
So this 401k thing, the EQRP is a form of a solo 401k. Is that right, Damien?
That's right.
So again, some people know about, well, many people know about IRAs. Some people know about the self-directed IRA, but we talked about some limitations. What most people don't know about, it's tedious to get a transaction done, and then this UBIT is, especially for real estate, is something like, what is this tax? I thought it was tax exempt. Well, apparently not when you're buying leveraged real estate. And so now there's this 401k, specifically the solo 401k. And so there's this other part of the tax code that really no one knows about, except for your audience and your book and things that you're trying to change that as well. But it's been around for a while. Talk a little bit about the history of 401k. Is this like a new invention that maybe you invented a few years ago, or like how safe is this solo 401k thing?
Yeah, this has been around since before Garrett and I were born. I think it may have been created on your birthday when you were born, Michael. It's
Yeah,
possible. It
yes,
was in the
that's
early
very good.
70s. I mean, it's been around a long time, and it's just it was built around Wall Street. And it was built around Wall Street making a lot of money and controlling things, but this is not something new. It just keeps evolving to give, like, here's what's new: the Roth component of retirement accounts. And how new is that? Not that new. I mean, that's still been around 20 plus years. So you've got these things that have a lot of history. They're very solid. There's no gray space in them, meaning it's black and white. And people that are thinking, well, you know what, I like the tax-free option. The only way to do tax-free and do real estate with leverage is a Roth Solo 401k or Roth EQRP. And that's because you can have all the leverage, you're exempt, and as the thing sells and you spend the money, there's no tax. So that's the ultimate tax planning strategy in the United States is the Roth 401k, hands down.
And the other thing, so you're preventing the UBIT, which is cool, but again, you're truly self-directing stuff. So because I have a EQRP with you guys, right? So if I need to sign a document, I don't need to send it to you. I just sign it myself, and then I get an actual checkbook, or I can even send a wire out of the financial institution that has the money. And so it really is basically, it's very fast, and it's almost like using my own money laying in another bank account.
Yeah,
And so from that perspective,
you're just wearing a different hat. You get to be the trustee, and
right.
it's very cool because as long as you don't disqualify yourself, meaning you're an idiot, which you're not, and people that take this on are, that they're and one of the things about custodians is for some people they just go, I don't trust myself, and so this isn't a good idea to give yourself checkbook control if you don't trust yourself. But most people that are watching and listening are smart enough to be able to write the check and make the investment that makes sense, and that's what
Oh,
you have the option to do.